Sorry, I think my volume was muted. Okay, welcome to our class today. I was saying that today I want to look at the statement of financial position. I will give you the layout today, and then we'll prepare it by weekend. We'll prepare it by weekend. We'll then prepare the statement of financial position. I'll give you the exact time by Friday. I'll give you the exact time by Friday. Right. So today we'll concentrate on the layout of a statement of financial position. Right. I think I'm not supposed to use this sheet. Let me just open the sheet so that everything can be in one place. That sheet that we were using. Right. I'm just opening the sheet that we've been using so that everything will be in one place.
So you're not sharing your screen, eh?
Yeah, I'm just opening it.
Okay, cool.
In a second, it will be open. Right, I'm now sharing it. Our statement of financial position. Right, the statement of financial position is actually the statement in which we apply our basic accounting equation, which is assets is equal to equity plus liabilities. Right, so now today I will look at the format as I said. We will have our statement of financial position. As it's at a given date. It can be 31 December, or remember that a financial year of a business can end even at any other time, which is not December. All right. When we're doing the statement of financial position, we start with the assets. Assets are the resources that are controlled by the entity as a result of past events. So these are economic resources controlled by the entity as a result of past events from which the entity expects to earn future economic benefits. Our assets are divided into two categories when we present them. We have got what we call non-current assets first. Right. When we talk about non-current assets, these are assets that are expected to be held or will be realized after more than a year. So we expect to have these assets for more than a year. Those are what we call non-current assets. So we expect to have them within our business for a period which is more than a year. Right. Our non-current assets, we normally have two. That is property, plant, and equipment. Right. Then what do we mean by property, plant, and equipment? These are tangible or with physical substance. Assets, excluding investment property. Expected to be held for more than a year. So when we talk about property, plant, and equipment, we mean all the tangible assets, excluding investment property. Investment property is a property that is rented out, like those flats that you see in towns that are rented out. They are investment property. They are also non-current assets, but they are shown separately. Right. Examples include land and buildings, of course, excluding investment property, that is land and buildings that are being rented out. We have got plant and machinery, furniture, and equipment. Some can call furniture and fittings. And in some businesses, furniture can be separate, equipment can be separate. Motor vehicles. Right. These non-current assets, these are shown in total for all items of property, plant, and equipment. So in our statement of financial position, we won't have a land and buildings. We won't have a machinery. We'll just have one figure: property, plant, and equipment. Right. And the amount in the financial position, in the statement of financial position, is the carrying amount at the reporting date. Right. Our carrying amount would be equal to cost less accumulated depreciation. Cost less accumulated depreciation. So we just record one amount, which is the carrying amount, which is cost less accumulated depreciation. We shall also show each other how to determine that cost less that carrying amount. Right. Then we can also have financial assets. What are these financial assets? Right. We include investment in shares. That means for shares which are expected to be held for more than a year. Then we've got fixed deposits, which are expected to mature after more than a year. So as long as we expect to liquidate them after a year, then there will be non-current assets. So if you've got a fixed deposit and you expect to withdraw it after 12 months, that becomes a non-current asset. It's a financial asset. All right. So these are our examples of non-current assets. Any questions? Right. Then we have got current assets. Current assets right. These are assets that are expected to be consumed or realized within the entity's normal operating cycle. And our demarcation is within what? Within a year. So we expect to use them within a year. These current assets, we expect to hold them for less than a year, right? They include inventories, right? Our inventories would include the following. This is stock of the following. At end of year. Right, trading inventory on hand. Stationery on hand. Please note that we didn't say stationery. If it's just stationery, it's an expense. But the stationery that has not yet been used, which is still held at the end of the year, which will only be used next year, that's the one that we include here. Packaging material on hand. This can be paper bags, boxes, crates, which we are keeping, which have not yet been used at the end of year. Consumables on hand. So if all these items are in stock at the end of the year, these are what we call inventories. Right. We have got trade and other receivables. Trades and other receivables. Right, that's trade receivables, which we also call debtors, or they can call it debtors control or accounts receivable. Less allowance for credit losses. At end of year. Less allowance for settlement discount granted. This is usually very rare. End of year. Usually we don't face this in our assessments, but if it's there, you know that you're supposed to deduct it. Then we also include accrued income. Remember that the main income is the sales, but on top of the sales, there can be other things that can also bring income. Things like rental income, things like commission income. If our customers are owing us any amount from there, that is accrued income. That is a amount owed by clients for other income. such as rental income. Maybe you've got a tenant who has not yet paid rental. Interest income, maybe put a fixed deposit, but the bank has not yet credited your account. So that will be included as a part of the trade in other receivables, because you'll be expecting to receive your money. So that's trade in other receivables. Right. You can also have prepaid expenses. Expenses already paid for future periods. Or we can also call them income expenses paid in advance. Let's say, for example, you've got a lot of cash and you are not sure of what will happen in the future, then you just pay your rent for the next 24 months to your landlord. Right. So any expenses that we've paid in advance, they will also be that they are an asset. Why? Because that amount still belongs to us until we've been provided with the service for which we paid. Right. We can have a VAT receivable. If remember from our previous classes, if a business is a VAT vendor, they are required to charge VAT to their clients. And when they charge VAT, when they charge the VAT, they are also charged VAT by their own suppliers. At the end of the period, they compare the VAT that they've been charged to the VAT which they've charged their clients. So then they will see if they owe us or not. So if your VAT input is more than the VAT output, that is the VAT that you've been charged by your suppliers is more than the VAT that you've charged your clients, SARS will then have to refund you the difference. So that will be an asset which is VAT receivable. Right. We also have financial assets. Financial assets is still those two, but this time around they are short term. So maybe let me just say financial assets. Then I just write that this is non-current assets. Right. Then down here, I would then say financial assets, current assets. So we can include investment in shares. These are shares held for trading. Or expected to be held for less than a year. Right. When a company buys shares in when a business buys shares in other companies, there are different motives. They can buy shares because they are cheap and they would like to sell them as soon as a right price is reached. So those, we call them shares held for trading. So such shares are current assets because anytime they will be sold. Then the ones that I talked about under non-current assets, those are the ones. These are not for trading. Maybe you are happy with the performance of the company and you are holding shares so that every year you can earn a dividend, a share of the profit of that company. Then it's a non-current asset. Right. Then under we also have fixed deposits that are to mature within a year. If you've got a 6-month fixed deposit, then that will be a current asset. Right. Then we also have what we call cash and cash equivalents. Right. Cash and cash equivalents includes the following: our bank, if favorable, positive or debit, then it will be an asset. If it's unfavorable, it's a liability. That will mean that it's an overdraft. Then we also have petty cash. We have cash float. We have cash. So all those things, they are also financial assets. These are also financial assets, but we normally show them separately as cash and cash equivalents. But you should be very careful with the bank, only if it is a debit. Right. So that means our cash and cash equivalents will come here. Then we add up our current assets. We get our total current assets. Then we get our total assets. Right. Our total assets is our total of the non-current assets plus the current assets added together. Those are the ones that give us the total assets. Right. Any questions on the assets?
Happy.
Right. Then we go to the equity and liabilities. We start with our equity. Our equity would be the capital. That is the capital at the end of the year. End of year. As per statement of changes in equity. So like if you are doing this figure here, like when we did the statement of changes in equity the last time, this figure here is the one that will be in the statement of financial position, this 37578,400. Then we can also have a revaluation surplus. Remember, revaluation surplus, this is when a land and buildings are revalued upwards. I think we know that in accounting, we record the loss in value of our assets and we call it depreciation. But we've got one asset that sometimes it doesn't depreciate, which is land and buildings. Instead of going down in value, land and buildings can go up in value. Then when they increase in value, that increase is what we call revaluation surplus. So it will be part of equity because it belongs to the owners. There are other things that that can be there, but I don't talk much about them because I don't expect you to be asked on those things like asset replacement reserve and stuff like that. Right. Then we've got our liabilities. Right. What are liabilities? Liabilities, these are amounts that are owed to third parties. I think we did that in our previous sessions. Right. So everything that you owe to all the parties outside the organization, those are what you call liabilities. Right. Then our liabilities, just like assets, are divided into two categories. We have got non-current liabilities. Right. When we talk about non-current liabilities, right, these are liabilities that are expected to be paid after more than a year. So as long as we expect to pay the amount after 12 months, that becomes a non-current liability. Right. Non-current liabilities, we normally bunch them together and call them long-term borrowings. Right. Long-term borrowings These are all liabilities expected to be settled after more than a year. So we expect to settle them after 12 months. Right. Examples: mortgage, bond, long-term loans, bank loans. Let's mention that as long as they are to be repaid after 12 months from the reporting date. So from that date that you are preparing the statement of financial position, all dates that will be, if you are reporting up to 31 May 2023, everything to be paid after 31 May 2024, that's a long-term borrowing. So as long as they are going to be paid after 12 months from that date, that the reporting date, then it's a long-term borrowing. So we batch them together and call them long-term borrowings. Right. Then we have, so these are long-term borrowings. Current liabilities. Current liabilities are those debts that we expect to settle within a year. These are debts that are expected to be settled within a year. Right. Examples, they include trade and other receivables. Right. When we talk about trade and other receivables, we include, sorry, not receivables, payables. Sorry about that. Receivables is an asset that we talked about when we dealt with current assets. Right. We talk about trade creditors or trade payables. And accrued expenses. That is expenses incurred but not yet paid at reporting date. For example, let's say you were using a room, but you didn't pay the landlord because of financial difficulties, or maybe because of difficulties we didn't pay part of the salaries, or we have not yet paid our insurance, although it was for the period, then that would be an accrued expense. Right. Then we also have income received in advance. Income received either for goods not yet delivered to the customer, or services not yet rendered to the customer. customer can come and he wants a big order. We tell him that the goods are not yet in. Then he said, okay, I will just pay for them. Just call me when the goods are in. So as long as we received money for which we have not yet provided a service, or maybe a tenant, instead of paying for the month of May, the last month, he then said, I'm paying for 3 months. And we are reporting on May, you also paid for June and July. So that is income received in advance. That is a liability because we owe the service to the client. Right, we're VAT payable. When we talk about VAT payable, that means your VAT output is greater than VAT input. That is the VAT that you received from your clients is more than the VAT input that you were charged by your own suppliers. So you are supposed to pay the difference to SARS. Right. We also have bank overdraft. So if our bank is negative, that will be part of the current liabilities. Sometimes we call it other financial liabilities instead of bank overdraft. Right. Then we can also have current portion of long-term borrowings. If we still remember, we talked about these long-term borrowings. We said these are liabilities that are expected to be paid after more than a year. But it can happen that some of them are paid in installments. For example, when you buy a motor vehicle on credit, you may be paying over 5 years. The fact that you are paying after, for more than a year, that's a long-term borrowing. But you have got 12 installments that are to be paid within the next 12 months. Maybe you are paying monthly. So those 12 installments you are going to pay monthly, they will no longer be under non-current, they will be recorded under the current liabilities. So these are installments on long-term borrowings. Which will be settled within a year. So all those installments that are going to be paid within the next 12 months. Or let me just say, or next 12 months. Right. So these are what you call current liabilities. So by their nature, these are liabilities that are to be repaid within 12 months. Right. Then we add up our equity plus these liabilities, current and non-current. We get what we call our total equity and liabilities. The total equity and liabilities should always be equal to the assets. So this total equity and liabilities should always be equal to the total assets. Total equity and liabilities should always be equal to the total assets. So this is the general layout of a statement of financial position. Any questions? Right. If you don't have any questions, I'll proceed and show you the other last thing on the layout. We said this property, plant and equipment will only show the total. Right, but the users will need to know what are those items that are on the property, plant and equipment, property, plant and equipment. So then a business prepares what is called notes to the financial statements. Financial statements of Eugenius Traders for the year ended let's say 31 May 2023. Right. Then they prepare a note which is called a property, plant, and equipment. Right. This note shows the breakdown of the property, plant, and equipment. Remember, we said in the statement of financial position, you just show one figure, which shows all the property, plant, and equipment. But this note now will now show you what are the items that are in property, plant, and equipment. So depending on the category, so we will have the following categories here. Right, we can have here land and buildings, plants and machinery, furniture and equipment, motor vehicles, then total. Total is simply the addition of all the columns. Right. When we are preparing the property, plant, and equipment, we start with what we call the carrying amount at the beginning of year. Which are the balances that are coming from the previous year. So these are the balances that are coming from the previous year. Right. Our carrying amount is calculated as follows. It is made up of cost, right, less accumulated depreciation. Right. So this is the accumulated depreciation. Right. Then we include what we call additions at cost. Right. Now, what are additions at cost? When we talk about additions at cost, these are assets that we acquired during the current year. And they will be included at their cost price, which includes purchase cost, delivery cost. Let me say purchase or construction cost, because we might even construct our own building. Delivery where relevant, that means we're saying transport. Installation costs, testing costs, you might test to see if the machine is working well. All these costs are included in the cost of the asset. So when we say cost, we include all these costs. Right. Then I think when you do accounting at a later stage, you are also going to learn about other costs that can be included. Revaluation during year. Normally the assets that is only revalued is land. What happens is at the end of the year, we call a qualified person, whom we call a sworn appraiser. They appraise our building, they value it. Let's say last year it was 800,000, then they come and say it's 850. We increase it by the 50,000. That 50,000 increase is what we call revaluation during year. So we're saying revaluation during year. These are increases in the value of buildings during the current year. It's determined by a qualified person. We have to find someone who understands the buildings. Then it determines the revaluation. Then we have got disposals during year. Right. Disposals during year. These are assets that are sold during the year. And they will be recorded as carrying amount. Sometimes we just show the carrying amount, or we will also show here, we would say cost, then we say less our accumulated depreciation on date of sale. Right. Right. Then depreciation for the year. Our depreciation is calculated based on the straight line method or on the diminishing balance method. Right. Then we get our carrying amount at the end of the year. Normally, if there's any revaluation, it will be cost or gross carrying amount. Only if there is a revaluation on the land and buildings. But otherwise, if there is no revaluation, it will just be cost. All right. So this is how we prepare our property, plant, and equipment note. So I didn't put the disposal here. It will now be a negative there. So this is how that is the general format of our property, plant, and equipment note. Any questions? All right. If we don't have any questions, then we'll continue weekend. I will tell you because I'm not yet sure of my schedule during the weekend. Because I wanted to finish weekend because I thought maybe it was due on the 13th, but I'm told that it's now due on the 18th, your assessment. So I think I was trying to see if we can fix a class during the weekend and also another one on Monday so that you grasp some of the concepts before you confront your assignments. Okay, so I'll tell you by Friday if we're going to have a class during the weekend, but Monday we're definitely going to have a class. Okay, thank you so much and God bless you richly and have a blessed day.